Welcome back, everyone, to the deep dive. And today we're diving deep into cryptocurrency arbitrage. It might sound a little intimidating at first, but stick with us. We'll break it down so you can really understand this strategy. We've got a ton of research, some interesting news articles, and even a pretty cool story from someone in an online community who apparently made bank with this strategy back in 2018. But the big question is, can you still make those kind of profits today?
That's a great question, and that's exactly what we're going to be exploring today. At its core, cryptocurrency arbitrage is all about taking advantage of price differences for the same crypto, but on different exchanges. Think of it like finding a killer deal online. You see something you want on one website for a certain price, and then boom, you find it on another website for way cheaper.
Right.
What do? You buy the cheaper one and sell it on the site with the higher price, right? Easy profit.
Yeah, totally. So instead of like clothes or gadgets, we're talking about buying and selling cryptocurrencies on different exchanges.
Gotcha. One of the sources we looked at gives a really specific example. They say you could buy Ethereum for, say, $5,000 on one exchange and then turn around and sell it on another exchange for $5,500. Boom, $500 profit just like that. But why? Why do these price differences even exist in the first place?
Right, good question. So it really all comes down to how these exchanges work. Each exchange has its own unique set of buyers and sellers, and the amount of trading going on, which is also called trading volume, can be drastically different from one exchange to the next. Imagine for a second you're trying to sell like a rare, super valuable antique in a tiny little town. You're probably going to struggle to find a buyer, someone who's actually willing to pay a fair price. Why? Well, because there just aren't that many potential buyers around, right?
Right, right.
It's the same thing with exchanges that have what we call low trading volume or low liquidity. So more buyers and sellers on an exchange means you can buy and sell large amounts of crypto pretty easily without like messing up the price too much, right? That's kind of what liquidity is all about.
Exactly. You got it. And to make things even more interesting, each exchange also has to deal with different local currencies and regulations, which just adds another layer of complexity to how prices are set. A cryptocurrency might be super popular in one country, leading to a higher price on a local exchange compared to like a big global exchange.
So basically, there are tons of different reasons why these price differences exist. But how does someone actually take advantage of them? Like, what does that look like in the real world?
Well, our sources actually dive into a pretty interesting story from way back in 2018. Apparently, this person in an online community noticed that newer exchanges, the ones that were less well known, often had these big price differences, and that's because they just didn't have as many traders. Less activity, less liquidity, maybe more
You
opportunity.
got it. This person was able to make some serious profits, something like 35% profit on each trade.
Of course, this was back in the Wild West days of crypto, and the market is a lot more, I guess, mature now.
So, is it even possible to do crypto arbitrage today, or is that just a thing of the past?
It's definitely still possible, but it requires a more, I guess, strategic approach. Those huge price caps you could find back then are definitely harder to come by these days.
I'm starting to see why our sources put us before this next section. They're really trying to highlight the key takeaways here.
Yeah, for sure. The first takeaway is that you absolutely need to find exchanges with significant price differences,
Yep.
but you can't just focus on the price gap itself. It's crucial to analyze the trading volume on those exchanges too. Remember, low trading volume can mean low liquidity, and that can really mess with your potential profit.
Okay, so first, bright idea. Look for price differences, but make sure the exchanges have enough action happening to support those price gaps. Makes sense. What's the next key thing we gotta know?
The next key insight focuses on local currencies, which we touched on earlier. Different exchanges are operating in different countries, which also means they deal with different currencies, right? Well, these varying exchange rates can actually create some really good opportunities for arbitrage.
So it's not just about comparing Bitcoin to Bitcoin, it's also about understanding how those local currency rates factor in, especially between international and local exchanges. That's pretty fascinating.
The final key insight is something you might have already guessed. The more you invest, the higher your potential for profit. But, and this is a big but, higher investments always come with higher risks.
That's a good point, for sure. It sounds like there's a ton to think about before diving headfirst into crypto arbitrage. But let's be real, hearing about someone making 35% profit back in 2018 is definitely tempting. So even though the market's gotten more, sophisticated, are there still opportunities out there to make decent profits today?
Let's take a look at a real-time example using Solana. Our sources point out a current price difference of 8.3% for Solana between Binance, which is a large international exchange, and BitBit, which is a smaller exchange. That's a pretty big gap, and it suggests there might be an arbitrage opportunity there.
Yeah, 8.3% does sound promising, but I remember you mentioned earlier how important trading volume is. So what about these two exchanges? Do they have enough activity going on to make this a real opportunity?
That's the million-dollar question, and it's something we need to figure out before jumping into any specific opportunity.
So before we break down this Solana example and get into the nitty-gritty of how an arbitrage trade could actually work, let's take a minute to highlight the risks involved, because I think our listeners are probably starting to see the potential here. Okay, so we've got this potential 8.3% profit just sitting there with Solana, but before we get too carried away, let's talk about the risks, because I know you mentioned no trading strategy is completely risk-free, especially when we're talking about the crypto world.
Yeah, you got it. Cryptocurrency prices can be like a roller coaster. Super volatile. What looks like a sweet price difference 1 minute can vanish in the blink of an eye. That can really mess with your profits.
So even if we find a good price gap and we've done our homework on those exchanges and made sure there's enough trading volume, there's still a chance that the price could just totally change before we can finish that arbitrage trade. What other risks should we be thinking about?
Well, think about it like this. When you buy stuff online, there are almost always fees involved, right? Transaction fees, processing fees, all that fun stuff. It's the same with crypto exchanges. Every time you buy or sell, you're most likely going to get hit with transaction fees. And they can be different depending on the exchange you're using.
Yeah, I see what you mean. Those fees can definitely eat into our profits, especially if we're dealing with multiple exchanges for a single arbitrage trade. Are there any other costs we should be factoring in?
For sure.
Yeah.
Don't forget about the time it takes to actually transfer your funds between those exchanges. Remember, we're buying on one and then selling on another, right? Well, those transfers aren't instant. Sometimes it can take a while. And during that time, the price of Solana could go up or down, which could wipe out our profit margin.
So transaction fees and transfer times, they can both impact our bottom line. What about the security of these exchanges, though? Is there a chance we could lose our fund, like get hacked or something?
Security is a huge deal in the crypto world. You always have to be careful. Exchanges are prime targets for hackers.
Yeah.
So yeah, it's a risk. Most of the reputable exchanges have some pretty serious security measures in place.
Yeah.
But there's always a chance, even if it's small, that something could happen.
That's a good reminder that we really need to do our homework on these exchanges. Check their security track record before we even think about transferring a bunch of crypto.
You got it. Do your research. It's always worth it. Look into the security protocols, their history, all that good stuff. Due diligence is key.
Okay, so we've covered a lot of ground here. We've got price volatility, transaction fees, transfer times, and security risks. Anything else we should be aware of before we jump into this Solana example?
One thing that often trips up people who are new to arbitrage is the whole psychological side of trading.
Yeah.
Crypto markets are famous for their, crazy price swings. It's easy to get caught up in the excitement, make rash decisions based on fear or greed. FOMO.
Oh, yeah. I can see how emotions could definitely cloud our judgment, especially when there's actual money at stake. What are some ways to avoid that trap, that emotional roller coaster?
Having a solid trading plan is crucial. I can't stress that enough. Before you even think about making a trade, sit down and figure out your entry and exit points. Know how much you're willing to invest, the price you'll buy Solana at, and the price you'll sell it at. Stick to the plan.
So it's like having a roadmap, right? We know where we're starting, where we want to end up, and we got to stick to the route no matter what, even if things get a little bumpy.
Exactly. And another helpful strategy is setting what's called a stop-loss order. It's basically telling the exchange, hey, if the price of Solana drops to this specific price, sell it automatically. This way you're limiting your potential losses if things go south.
That's a good way to protect ourselves, like a safety net. It seems like discipline and emotional control are just as important as understanding the technical stuff when it comes to arbitrage.
Couldn't agree more. Crypto arbitrage, it's not a magic get-rich-quick scheme. It takes planning, research, and a level head. You got to think things through.
Speaking of research, let's get back to that Solana opportunity we were talking about.
Yeah.
You mentioned an 8.3% price difference between Binance and BitBit, right? Can we walk through how this trade would actually work, like step by step?
Sure, let's break it down. First things first, you would buy Solana on Binance because they have the lower price right now. Then you would need to transfer your Solana from Binance to BitBit, the exchange where the price is higher. Pretty straightforward so far.
Okay, so buy low on Binance, transfer to BitBit, and then what?
Once that Solana lands in your BitBit wallet, you're going to sell it for USDT, which is a stable coin that's basically pegged to the US dollar. This way you're locking in your profit in a more stable asset, one that isn't going to fluctuate as much.
Yeah.
Last but not least, you withdraw your USDT to a safe and secure wallet or even your bank account.
So buy Solana on Binance, transfer it over to BitBit, sell it for USDT, and then withdraw the cash. Got it.
Seems pretty simple when you lay it out like that. But I'm remembering all those risks we talked about earlier. How can we make sure this 8.3% profit doesn't just disappear during the process?
That's where the planning and understanding the market comes in. Before you even hit that buy button on Binance, double check the trading volume on both exchanges. If either of them have low liquidity, it could mess with the price when you try to make your trades.
Okay, so we got to check the trading volume, make sure there's enough liquidity. What about those transaction fees? How do we figure those into our profit calculations? Good question. Before you do anything, look up the fees for both Binance and BitBit. These fees are usually a percentage of your total transaction amount. So do the math, figure out how much you'll be spending on fees for both buying and selling Solana, and subtract that from your potential profit. That'll give you a more realistic picture.
So after we've got the fees figured out, then we need to think about those transfer times. How long does it usually take to move Solana between exchanges?
Transfer times can be a bit unpredictable, to be honest. They depend on how congested the network is and which exchanges you're using. Could be minutes, could be hours. And don't forget, the price of Solana can change during that transfer time, so you got to keep a close eye on the market.
So stay alert, be ready to adapt. Is there anything else we can do to manage those risks during the transfer?
Some people who do arbitrage use what's called limit orders. So instead of buying Solana at whatever the market price is on Binance, you can set a limit order, which basically means you tell the exchange, hey, I'm only willing to pay this much. That way you won't accidentally overpay if the price jumps up all of a sudden.
And I'm guessing we can do the same thing on BitBit, right? Set a minimum price we're willing to sell for.
Exactly. Limit orders give you more control over your entry and exit points. It helps reduce the impact of those crazy price swings during the whole arbitrage process.
This whole Solana example is really showing how important research, planning, and risk management really are. It's definitely not as simple as, oh, look, a price difference, let's make some money.
Yeah, you got to be smart about it. Successful crypto arbitrage requires a real understanding of the market, a solid plan, and the discipline to stick to it no matter what. But even with the best planning in the world, there are still risks involved. It's just the nature of the beast.
Right. Before we wrap up this deep dive, I'm curious about something our sources mentioned about how crypto arbitrage has changed over time. They said the market has matured and that those big, juicy profit opportunities are becoming less common.
Yeah, that's a good observation. As the crypto market gets more efficient, those really obvious price differences are getting harder and harder to find. Everyone's looking for them.
So does that mean the days of crypto arbitrage are numbered? Is this whole strategy becoming a thing of the past? So is this the end of crypto arbitrage? Like, is it over?
Like, not so fast. While those super easy opportunities are definitely fading, the whole game's changing. It's evolving. Instead of going for those massive price gaps, people doing arbitrage are starting to think differently. They're looking for smaller profits, but more frequent ones.
So instead of hitting a home run, it's more about getting a bunch of base hits, racking up those gains over time?
Exactly. It's a different strategy. And technology is a big part of it too. We're starting to see some pretty sophisticated algorithms and trading bots. They're designed to spot and pounce on these tiny price differences across exchanges. It's happening super fast.
So you're saying the future of crypto arbitrage is less about, doing it manually and more about using these automated tools?
That seems to be where things are heading, yeah. And this kind of brings us back to what we were talking about earlier, the risks, and why it's so important to know what you're doing. Even with these fancy automated tools, you got to understand the markets, how to manage risk, and how these tools actually work. Otherwise, you're just gambling.
So even though technology is changing the game, the basic principles of crypto arbitrage are still the same. You need to do your research, have a strategy, and be a little bit savvy to navigate this whole world.
Absolutely. And never forget, the crypto market never stands still. It's constantly changing. What works today might be totally useless tomorrow. So you always got to be learning, adapting, and staying ahead of the curve.
Well said. So for our listeners who have been with us on this deep dive into crypto arbitrage, what are the main takeaways? What should they be thinking about if they want to explore this strategy further?
Okay, first and foremost, remember this. Crypto arbitrage is not a way to get rich quick. It's not like a passive income stream that just magically appears. It's work, plain and simple. You need knowledge, you need a plan, and you got to know how to manage risk. It's not for the faint of heart.
Right, exactly. We've seen how volatile prices, those pesky transaction fees, transfer times, and security risks can really eat into your profits. It's definitely not as easy as it looks from the outside looking in.
But if you're willing to put in the time and effort, crypto arbitrage can be a good strategy. The key is to really research those exchanges, understand the cryptocurrencies you're trading, have a solid plan, manage your risks, and be ready to adapt because the market is always changing.
And like you said, don't be afraid to use technology to your advantage. Check out those automated tools, but do your research. Make sure you understand how they work and what the risks are before you put your money on the line.
Cryptocurrency. It's a wild world, man. Dynamic, exciting, and a little bit crazy. Arbitrage is just one small piece of the puzzle. So as you keep learning and exploring, stay curious, be a little skeptical, and never stop learning. That's the key.
Couldn't have said it better myself. So before we wrap things up, we want to leave our listeners with one final thought. Now that you know a bit more about crypto arbitrage, what are the things you would personally consider before jumping in? What questions would you ask yourself?
Think about your risk tolerance. How much risk are you comfortable with? Are you okay with the possibility of losing money? Think about how much capital you have to invest, how much time you're willing to dedicate to this, and what your overall goals are. What are you hoping to achieve?
Because, let's be honest, crypto arbitrage isn't for everyone. It's not a one-size-fits-all kind of thing. It takes a certain personality, a willingness to learn, and a careful approach to risk. But if you're up for the challenge, it can be an exciting and hopefully profitable journey.
So do your research, weigh the pros and cons, think it through carefully, and make a decision that's right for you and your situation. And never forget, knowledge is power. The more you know about this world, the better prepared you'll be.
And on that note, we've reached the end of our deep dive into the wild world of cryptocurrency arbitrage. We hope you found this exploration helpful and maybe learned a thing or two. Thanks for joining us on the deep dive. We'll catch you in the next one.